All right, hi everyone. Welcome to today's webinar brought to you by Vantage, where today we're going to be taking a look at the evolution of the US tariffs and the current status as well. All right, before we begin, please take note that we are streaming directly into the Vantage app as well as over Zoom, so do not hesitate to drop your questions in the relevant chat boxes as we progress through today's webinar. All right, so before we begin, please take note of the disclaimer. The information, context, and opinions which are expressed in this presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage, and are solely used for educational purposes as they do not constitute investment advice and/or consultation on how a client should trade. Also, take note of the risk warning that comes with trading margin forex and CFDs, as they carry significant risk and is not suitable for all investors. My name is Ketan Ramachandra, and this webinar series is brought to you in the special partnership between Vantage and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right, so here's the agenda for today, right? There's a lot of things that has taken place since Liberation Day, which was on the 2nd of April, and that's the date when the White House announced a slew of trade tariffs against its major trading partners, right? So all of that has raised global trade uncertainties, right, has raised or has spiked volatility as well due to potential tariff implementation and escalation. Right, and we'll also take a look at which asset classes have been impacted the most and why. All right, so it all begins with Liberation Day, right? This was April the 2nd, was labeled by the White House as a day of announcing a slew of trade tariffs that would help reposition the US as a major powerhouse once more. Now, what happened on this date was the Trump administration announced sweeping reciprocal tariffs under the International Emergency Economies Powers Act, citing trade deficits as a national emergency. Now, this tariff regime consisted of two main components. The first one is a 10% baseline tariff on all imports from countries except Canada and Mexico, effective 5th of April. Now, the second component was the additional tariffs on major trading partners beginning on 9th of April, with primarily, no, just a little bit of a typo here. Go. With countries such as China being levied 34%. This is on top of a prior 20% tariff, bringing the total back then to 54%. The European Union was levied with 20%, India with 26%, Japan with 24%, South Korea with 25%, and with Vietnam a whopping 46%. Now, prior to Liberation Day, right, which was back in February and March of this year, the US had also imposed 25% tariffs on steel and aluminium products or imports from Canada, Mexico, and China, right? And there was also additional 25% tariffs on auto imports not compliant with the USMCA agreement. Now, the USMCA agreement is a trade deal uh, uh, is a trade deal between the US, Mexico, and Canada. Now, the overall objective of the tariffs were aimed to protect American industries and address trade imbalances, but unfortunately, it sparked immediate global backlash and caused market volatility to surge as well. Now, let's take a look at how the trade tariff has evolved since the 2nd of April. Right, as widely expected, right, no country is going to sit back, right? In general, no country would sit back, and we were expecting some sort of escalation and retaliatory tariffs being imposed on the US as well, particularly from countries like China, the European Union, and maybe even Canada and or Mexico. Now, beginning with China, right? China retaliated with a 34% tariff on US goods on 4th of April, and that escalated to 125% by the 10th. Right? This also included non-tariff measures such as export controls on rare earth materials. Now, China signaled this as its final tit-for-tat tariff, but reserved the right for further non-tariff retaliation. So this was on the 10th of April. Now, moving over to the European Union, they announced a 17% effective tariff on US goods and prepared countermeasures, with European Commission President Ursula von der Leyen emphasizing protection of EU interests. Canada, right, their neighbor to the north, imposed 25% retaliatory tariffs on US vehicles in response to US tariffs on Canadian steel, aluminium, and auto vehicles. Mexico, right, initially adopted a conciliatory approach, avoiding immediate retaliation. Right. However, President Claudia Sheinbaum announced potential countermeasures if U.S. Tariffs persisted, but exemptions for USMCA compliant goods were extended indefinitely on the 2nd of April. Now, Japan expressed regret but refrained from immediate retaliation and attempted to seek exemptions through negotiations. Other partners such as Vietnam, Cambodia, and Indonesia faced high tariffs as well, with Vietnam offering to slash tariffs on US imports all the way down to zero, although this was not accepted by the US back then. Now, there was some partial de-escalation in the following week, right when U.S. President Donald Trump announced a 90-day pause on the additional country-specific tariffs, except for China, where tariffs were raised to 125%. Right, so the 10% baseline tariff remained in place, and USMCA non-compliant goods from Canada and Mexico continued to face the additional 25% tariffs. Now, this partial reversal was framed as a reward for countries refraining from retaliation and also a strategy to isolate China. Now, this move was seen as a tactical shift to gain negotiating leverage, with Treasury Secretary Scott Bessent suggesting it was part of a broader strategy to encourage trade deals. Now, there was further de-escalation on the 10th of May, right? Uh, and this announcement of a trade deal framework between the US and the UK brought some cheer to the market and improved overall sentiment, right? So, the trade deal and the framework had been concluded, but there was still a lot of specific issues to be ironed out. But nevertheless, this was one of the first signs of major de-escalation and that took place on 10th of May between the US and the UK. Now, there was further de-escalation on the following week. Remember, 10th of May was a Thursday, 12th of May was a Monday, and this was the big one, right? This was the big one where we saw China and US come to agreements, right? There had been trade negotiations taking place in the weekend before on Saturday, Sunday, 10th and 11th of May over in Geneva, and the talks had been hailed as substantial progress. Right. So what had happened over that weekend was that the US and China agreed to a 90-day tariff reduction, reducing US tariffs on Chinese goods from 125% down to 10%, while Chinese tariffs on US goods were also reduced down from 125% to 10%. Now, this excluded this excluded the 20% fentanyl tariff, sorry, not tax, but fentanyl related tariff on China. Now, the latest move was described as a temporary de-escalation, not a final deal, which was aimed at fostering cooperation. Now, other trading partners, including the EU, Canada, and Japan, continued negotiations to avoid further escalation, with the UK opting for a cooperative approach by not imposing retaliatory tariffs. So you could see here from mid mid-May, basically from 10th and 12th of May, we received two relatively significant news of de-escalation. But although, of course, there's no formal trade agreement being signed off just yet, but at least the negotiations are moving in the right direction, which is helping to improve overall market sentiment while helping to reduce market stress as well as reduce market volatility as well. Now, what would the impact on financial markets, right? Now that we know what had happened, what had transpired, and how things had evolved since 2nd of April till the 12th of May, basically since last week, let's see what was the impact on financial markets when we look across at the various asset classes. Right, so starting with equities, because this was the asset class that was impacted the most, right? We saw the VIX surge, and while we saw the major indices tanking, right, we saw most of the major indices enter bear market territory, with many single name stocks dropping as much as 30 or even 40% over this period here. Now, the S&P 500 dropped nearly 5% on 3rd April, marking its first day since June 2020, right, with a cumulative $6 trillion lost of market value over 4 days. Tech giants such as Apple were down 9% on that day, And consumer brands like Nike were also hit hard due to reliance on global supply chains, particularly from countries in China, particularly from supply chains in China, Vietnam, and Indonesia. The Nasdaq 100, right, which is the big tech, which is the index that tracks the big tech, entered a bear market as well, as reflecting heavy exposure to tech firms reliant on Asian manufacturing. Now, for tariffs increased costs for imported components and disrupted supply chains, hampering corporate earning expectations, raising uncertainty, like drastically raising uncertainty and fears of a global recession, which amplified the sell-off in the stock market. Right, so you can see here not only U.S. equities but global equities were the asset class that was most impacted following the announcement of following Liberation Day and the escalation that evolved over the next few weeks or next couple of weeks after that. Now, looking at the S&P 500, right? The SPY is the ETF that tracks the S&P 500 index, and we can see here prior to 2nd of April, this ETF had already started to pull back quite sharply. I would say it had dropped already about 10% before by the end of March, right? And then on 2nd of April, when Liberation Day was announced, we can see the third day, right, 3rd of April, S&P 500 closing down well over 5%. Remember, in February and March, there had already been tariffs being announced for imports on commodities such as steel and aluminium, and that had already started to shaken up financial markets even before Liberation Day. So, Liberation Day basically accelerated the sell-off and caused major equity indices to fall into bear market territory. Now, on 7th of April, we can see the S&P. Later on, when we go on to the charts, right? However, on 7th of April, we did see the S&P 500 briefly enter bear market territory, right? As it dropped towards $480. This was about a 21% drop of its peak in mid-Feb, right? Briefly entering bear market territory before rebounding quite sharply to close above $500. Right, nevertheless, it was still in a very deep correction, and then it continued to face strong volatility up till the end of April. Now, looking at the Nasdaq 100, right, the triple Qs is the ETF that tracks the Nasdaq 100 ETF, and similarly to the S&P 500, we can see this index or this ETF was also selling off sharply in February and March, right, and the announcement of additional tariffs on 2nd of April really drove the stake through the heart, causing this ETF to fall relatively deep into bear market territory, dropping as much as 25% at its lowest point on 7th of April. And once again, right, there was a lot of volatility from 7th of April till the final week of April, and we've seen a strong rebound since then, right? Now, looking at bonds, right, US Treasuries showed dysfunction as well, with yields swinging wildly by 15 basis points in hours, resembling March 2020 market stress. Right, typically investors seek safety in bonds, but uncertainty about tariff-driven inflation limited their appeal. Right, so initially yields did fall in the first couple of days. I remember as uh, Liberation Day took place, rather, right? We saw equity markets sold off. Bonds were initially bought as well as the safe haven asset. But after that, after a couple of days, we actually saw yields start to surge as well, particularly as the appeal for treasury bonds waned, right? Especially about uncertainty due to tariff-driven inflation. Now, tariff-induced inflation fears raise concerns about Fed policy, with markets doubting the Fed's ability to cut rates should inflation reach or climb above their target of 2%. Right, so you can see here, this is the 10-year US Treasury bond yield, and you can see that yields were around 4.3% prior to that, and you can see from the beginning of the year till the end of March, yields had fallen from 4.8% down to as low as 4.15%. Now, as yields are falling, right, bond prices are rising. So take note, bond prices and yields have an inverse relationship. So that means if bond prices are rising, bond yields are falling and vice versa, right? So that means as yields are falling, it signals demand for US Treasuries. Now that was what had taken place and continued to take place from mid-January all the way till 7th of April, right? As investors sought out US Treasuries as a safe haven asset. However, as more information came to light, right, the appeal for US Treasuries uh, waned, right? It waned and it caused uh, investors to hold back on buying bonds, and some may even have resorted to selling off their existing bond holdings as well. Traders, investors, and speculators alike. As you can see here, bond yield surging from about as low as 3.9% in the first week of April, climbing briefly climbing above 4.5% by mid-April. Right, since then, yields have continued to remain elevated, but now we look to see yields retreating away from the 4.5% uh, level. Right, this is for the US 10-year Treasury bond yield. Looking at the 30-year bond yield, we can see that the bond yields were moving in a similar direction, where you could see US Treasury bonds being sought after from mid-June till the end of April, right, as the US 30-year bond yield went from 5% down to as low as 4.4%. And then we saw yields surge once more, and they continue to remain relatively elevated as well. Now, commodities, right? Initially, initially, gold sold off as well, right? Gold being a precious metal, being a safe haven asset, right? It initially sold off before being sought after as a safe haven asset, right? So gold uh, initially took a hit before reversing, and as investors clamored in to buy this precious metal, gold continued to hit record highs as a safe haven asset amidst market turmoil. Oil prices tanked as well, right? As global uncertainties rose, recession fears rise, oil prices will fall as well, right? So that's what had happened. Initially, oil prices initially fell on 2nd of April, but prior to that, oil prices had already been under pressure since mid-January due to the announcement of the energy policy by President Trump, right? His energy policy, which was aimed at expanding oil and gas production in the US. Now, remember, when the US is already the world's largest producer of crude oil, they've already overtaken Saudi Arabia, and if they are able to continue to expand even further, right? Increase production, right? That's going to create a lot of oversupply, or potentially create a lot of oversupply in oil markets, especially during a period or during an environment where global demand growth is weak, right? So that will cause oil prices to to fall as well, right? Which was their objective. The objective of increasing oil and gas production in the US was to drive energy prices lower. This is for crude oil, natural gas as well, right? All of which is to bring down inflation, which has worked out pretty well if you look at where energy prices are currently trading as to where they were at the beginning of the year. Now we can see here, this is the daily chart for spot gold, XAU USD, and we can see that on 2nd of April, gold initially climbed a little bit higher, marking a new intraday all-time high on the 3rd of April before pulling back quite sharply, right, dropping all the way down to around $2,950 per ounce. But after that, in the second week of April, that's when the investors climbed back into gold and started to buy this precious metal as safe haven demand started to increase, driving gold prices as high as $3,500 per ounce. Now, this was in, um, I believe this was on 22nd of April, where gold prices hit its most recent intraday all-time high, surging to about $3,500 per ounce. But since then, we've seen gold being pretty volatile between 22nd of April and the first week of May. And then since we've seen firm news of potential de-escalation uh, taking place from the perspective of trade negotiations, we've seen demand for gold fall off as well. And this has caused prices to pull back quite sharply, dropping down as low as $3,150 per ounce last week. As you can see here, as further de-escalation uh, news emerges from the White House and from the major trading partners of the US, right? This is going to cause demand for safe haven assets to taper off, and that could mean gold prices are likely to pull back as well. Now take note, there's also been a lot of central bank buying over the last couple of years, right? Central banks have been a huge buyer of physical gold, and that has uh, not only kept prices supported, but it also has kept oil prices surging higher as well. So, nevertheless, despite potential de-escalation uh, talks that could take place, right, putting downward pressure on gold prices, nevertheless, we still have a very strong buy in the market, and these are central banks, and they could at least keep gold prices elevated over the near term as well. Now, looking at oil, right, we can see here after briefly hitting $81 per barrel back in middle of January, right? Take note, this is the chart for crude oil futures, WTI crude oil futures, which hit $81 per barrel in mid-January. And then remember, 20 years of Jan was President Trump's inauguration, where he announced and signed off on a bunch of executive orders, and one of them was related to the energy sector, which was right his drill baby drill agenda. Right, he signed off to expand oil and gas production in the U.S. Right, all of this was to drive prices for crude oil, diesel, and natural gas lower, and this was all done to combat inflation, right, to tackle inflation and keep uh, price pressures at a control level. So you can see here, since middle of January, oil prices had already started to fall quite rapidly, right, dropping from $81 per barrel in middle of January down as low as $66 by the beginning of March. Right, this was about a $15 drop in oil, right, almost a 20% drop in a matter of a couple of months. Right, and then we saw oil prices retrace a little bit higher, right? As oil prices retrace higher, there was the huge shock of Liberation Day, right, when a slew of tariffs, massive tariffs were announced and levied against the major trading partners of the US, and that really drove oil prices down another leg lower, right? We saw oil prices, WTI oil crude futures, tanking from $72 per barrel down as low as $56 per barrel. This was another $16 drop, right? Almost another or slightly more than 20% drop in within a week or so. Right, since then, oil prices have sort of consolidated and have continued to range between $56 per barrel on the lower bound and be restricted at around $64 per barrel on the upper bound. Right, as we saw trade de-escalation news emerge from the White House and from major financial news media outlets, we saw demand for WTI oil pick up as well. Right, remember we had the first de-escalation news, which was between the US and the UK, where a trade deal framework had been announced. And of course, the big one was on Monday, 12th of May, where we saw another trade deal agreement being being announced as well between the US and China. Right. So since then, we've seen oil prices rebound quite strongly, but nevertheless, they're still off the highs of January. Right. January's high was about $81 per barrel, and oil prices are currently about $20 off that mark. Right. So nevertheless, with potential oversupply concerns due to increased oil and gas production in the US, also due to OPEC and OPEC Plus announcing uh, measures to increase production capabilities, right? Raising fears of oversupply in the market in an environment where global demand growth looks to be pretty weak. So oil prices continue to remain under pressure, but of course we can expect uh, strong rebounds and rallies or counter trend rallies for this commodity as we progress over the next few weeks. Now, coming to currencies, right? The US dollar slumped as well, right? Over the first few weeks, we saw the US dollar demand for the dollar tanking, right? And then it, of course, uh, started to strengthen following the escalation news from 10th and 12th of May. Now, currency such as the Japanese yen and Swiss franc also appreciated significantly due to their status as safe haven currencies during peak uncertainty. Right, so tariff uncertainty weakened confidence in U.S. assets. That's why we saw the dollar being sold off aggressively, and we also saw U.S. Treasuries being sold off aggressively at the same time as well. And since the last week or so, we've seen this de-escalation restore some dollar strength and also bring back some buyers back into the bond market as well. Right, still early days. Right, we're still early days in the journey of potential de-escalation and the formalization of new trade deals between the US and the various and its major trading partners. Now, looking at the dollar index, right, we can see here the dollar index hit a high of 110 in mid-January, and since then, it had already started to lose its value, right, dropping down as low as 103 by middle of March, losing almost let's see, about 10% by then, right? Almost 110, about, yeah, close to about 8, 7 to 8% by then. And after Liberation Day, that's when it really tanked as well, dropping as low as 98, right? And as we saw uh, market sentiment improve, as we saw volatility recede from financial markets, we saw demand start to pick up once more. However, we've seen now the dollar come under pressure once again. Looking at dollar yen, right? Dollar yen um, had already been falling, right, since mid-January as well, right? After hitting briefly hitting 159 back in mid-January, demand for the Japanese yen increased, causing this currency pair to drop rapidly as well. And remember, in February and March as well, there were also tariffs being uh, imposed on aluminium and steel and iron ore imports. All of that raising uncertainty and raising fears, which cause demand for the Japanese yen to increase as well, right? Remember, the yen and the Swiss franc are safe haven assets, right? Or safe haven currencies are deemed as safe haven currencies. And in terms of, and in periods of market volatility or increased market volatility, we're going to see demand for these currencies increase quite noticeably, and that causes dollar yen and dollar franc to fall quite sharply. And of course, once uh, Liberation Day had arrived and the markets received a huge shock, we continue to see dollar yen continue to sell off very sharply as well. Right. Similarly for dollar franc as well, dollar franc has lost quite substantially. I think dropping as much as 12 or 15% since mid-January. And as markets calm down and volatility receded from financial markets, we saw the dollar yen increase or rebound, and we also saw dollar franc rebound as well. Now, signs of improvement, right? We've seen several signs of improvement over the last couple of weeks. Right. First of all was the 90-day tariff pause announced on 9th of April for most trading partners except for China, right? Which helped to ease immediate tensions. This also triggered a historic market rally, with Japan's Nikkei surging nearly 9% and the S&P 500 recovering some losses. Now, the US-China tariff reduction, that was the big one, on 12th of May, further de-escalated tensions, spurring global market gains, higher bond yields, and a slightly stronger US dollar as well. Right, negotiations with countries like Japan, South Korea, and Vietnam continue to take place, and the UK's decision to avoid retaliation signaled a shift towards diplomacy. Now, EU and Canada have maintained measured retaliatory stances, focusing on negotiations rather than escalating tariffs further. Right, so all of these have combined, right, in sort of easing market worries and helping to calm the overall sentiment as well. Now, summary, just to summarize what has taken place, right? Let's take a look at it from the aspect of financial market response. Right, post 9 April, the tariff pause had led to a global stock market surge, with Asian markets like the Nikkei jumping nearly 9%, while US equities partially recovered, although the S&P 500 continues to remain volatile due to lingering China-specific tariffs. Remember, it's only no formal trade deals have been signed off just yet, right? Whether it's between the US and China or US and the UK or any other country, right? It is all currently still in flux. It's just trade deal frameworks have been announced, right? They just announced trade deal frameworks, and there's still a lot of issues to be ironed out over the next few weeks and maybe even months. Now, post 12th May, the US China tariff reduction drove global stock markets even higher, with European shares posting a fifth straight weekly gain, while the dollar strengthened, along with oil prices signaling optimism about trade stabilization. Now, despite all of that, volatility still persists, right? Despite all the strong rallies in global equity markets, right? They continue to remain sensitive to policy uncertainty, right? And this was reflected earlier in April as well, with the VIX surging to panic levels in early April, but has since moderated. Now, the outlook, of course, is to remain cautious, whether we're investors, traders, right? The outlook is always to remain cautious, right? While recent de-escalation has improved market sentiment, uncertainty persists due to the temporary nature of the 90-day pauses and the ongoing US-China tensions. Remember, everything still remains in flux, and volatility can creep back in very quickly as well. There's also concerns of potential stagflation risk, particularly in the US, right? Not only in the US, but it could also impact other major developed economies as well, right? As economists warn of potential stagflation risk in the US, with JP Morgan forecasting a 0.3% GDP decline in the fourth quarter of 2025, and have also signaled a 60% recession risk globally if tariffs re-escalate. Now, the situation remains fluid, with outcomes hinging on a country by country basis, right, with regards to the outcome of each negotiations and the US strategic focus on decoupling from China as well. Right. So, with that, now let's move on over to the charts and trading view, right, and see how markets are currently uh, trading, right? We can see here, right? And also remember late on Friday, right, we also had some concerns, right, on Friday, 16th of May, right, where the ratings agency Moody's had downgraded the US credit, right, that removed its AAA status, raising some uncertainty as well, which caused equity markets to pull back slightly on Monday, this Monday as markets reopen, and causing the dollar to lose steam as well, falling as it fell quite sharply on Monday, the 19th, right? Since the Moody's announcement, which was late on Friday, which was 16th of May, right? We've seen the dollar index drop nearly 1% over the last couple of days, right? And we can see that the dollar still continues to be out of favor amongst investors and traders alike. Now let's try to identify the key support and resistance levels for the dollar index, right? You can see here, right after rising as high as 101.80, we saw the dollar index stall around this level on 12th of May, and it actually stalled, and what I can see is a very significant overlap. Right, when I look at this level at 101.80, effectively just 101.80, this is a very significant overlap, which we can identify or label as the first resistance. Right, we can see here this level had functioned as resistance in early September and mid-September of last year. It had also functioned as pretty decent support in the first week of April. So this creates a very nice overlap where we saw the dollar index stall exactly 2 Mondays ago on 12th of May, right? You can see a very significant barrier for dollar index at 101.80, and that's where the first resistance has been identified. Now, there's also a couple of Fibonacci retracements that we can draw. Let's try from uh, this swing high on 13th of Jan, going down to the swing low here on 21st of April, taking a look at all the fibs. Right, on this downtrend, we can see that none of the Fibonacci retracements align close enough to the first resistance, so that's fine. Let's not force the Fibonacci retracement onto the analysis, right? If it doesn't align close to a predefined resistance or support level. Let's try another retracement, this time starting from 28th of Feb. And in this case, as the dollar index was rising uh, quite steadily in the first week of May, right, it was approaching an overlap level, right? Remember, this overlap level had already been identified. It was approaching an overlap level that was accompanied by a Fibonacci retracement at 13.2%. Now, of course, with the dollar index climbing above the 13.2% retracement on Monday, 12th of May, this retracement level can no longer be used. So we're going to remove it from the analysis as well. Now I'm going to try one more retracement, this time starting from this swing high on 26th of March, and we can see here in this case, the 61.8% retracement is a level that we can currently use in the analysis at the present moment. Right, so this is how the first resistance has been identified. It's an overlap level at 101.80, which is also accompanied by a Fibonacci retracement at 61.8%. And we can also see that the dollar index continues to trade underneath the red Ichimoku cloud, all of which highlighting a very strong resistance barrier around this zone over here. Now, in terms of support, very clearly the first major support sits close to the swing low that was formed on 21st of April. But when we zoom out, when we zoom out and look at the chart for the dollar index back in March of 2022, we can see this is actually a very significant support level sitting at 97.76. We can see back in March of 2022, from 10th of March till 1st of April, this level served as a multi-swing low support. We can see dollar index bouncing off this level not once, not twice, but 3 times, signaling very strong support at this level here. And this is where we've identified the first support. And when we come back and we come to the present moment, when we see where dollar index is trading, we can see that it came very close to this support level and reversed just off it. We can see a very strong support at 97.76. Now, with dollar index falling, right, we can also see that I can also see that it's testing a pretty decent intermediate overlap. When I look at this level at 100.20, this is a pretty decent overlap level. Why is that the case? Because we can see strong support taking place here at the end of September of last year. We can see resistance being formed on 15th of April and 2nd of May of this year. So this creates a pretty decent overlap level where dollar index seems to have held up since 14th of May. However, this level looks like it could give way this week. So if we do see a clean break below this intermediate overlap, intermediate support, which is an overlap level at 100.20, we can probably expect the dollar index to slide even lower. So keep an eye out on this intermediate support level at 102.21 is a nice overlap support. Now on this uptrend, we can also run a Fibonacci retracement starting from this swing low here on 21st of April, going up to the high on 12th of May. Looking at all the fibs, we can see that the 50% retracement sits just underneath the intermediate support at 100.21. So let's keep 50% in the analysis here. So take note, dollar index has managed to remain above this support zone for now or for this week. However, if this level gives way, I think we can expect the dollar to be sold off even more aggressively, paving the way for it to slide down towards 99 and beyond. Right now, these are the key levels for the dollar index on the daily time frame with the first resistance and support levels being identified, as well as with an intermediate support zone at around 100.20. Right now, let's look at the S&P 500 index, and we'll look at that by looking at the S&P 500 ETF. So the SPY is the ETF that tracks the S&P 500 index, and we can see after it made its intraday all-time high on 19th of Feb, right? This ETF had dropped more than 21%, falling briefly into bear market territory on Monday, 7th of April, before exiting bear market territory to close up on the day, but it was still down almost 18% since its intraday all-time high. So still, it was in a very deep correction. And after a couple of about 10 more days of volatility, we finally saw the S&P 500 or the SPY ETF climb out of its recent bottom here and make a very strong rally since then, right? So with that, now let's try and identify where the key support and resistance levels sit for this ETF. Right now, clearly the first major resistance is going to be close to the intraday all-time high that was formed on 19th of Feb, and that level sits at around $630. Now, there's also an intermediate resistance level that I can sort of spot as well. There's somewhat of an intermediate support level at around $598. And we can see here support being formed here on 12th of February. And then we see resistance being formed from the 26th of Feb till the 3rd of May, creating a pretty decent overlap that we can identify as an intermediate resistance at 598. Now on this downtrend, we can probably run a Fibonacci retracement, but I suspect that all the retracements have already been breached, right? We can see that the S&P 500 has rallied very strongly, climbing above all the retracements from all the way from 23.6% up to 17.6%. So that's fine. We can't use the retracement here. However, I would like to try to use the retracement from this high on 26th of March. The purpose of this retracement is to look for extension levels. Key extension levels sit at 137 and 161%. And you can see this intermediate resistance that I identified at $598.50. We can see that the extension at 137% sits quite close to it. So we have identified a pretty decent resistance barrier right on the first most immediate resistance barrier for the SPY ETF, which is between $598 and $602. Right, we don't really need the extension at 161% at the present moment, right? So that's fine. But nevertheless, this is the first resistance at $613 for the SPY ETF, which is the swing high resistance. And of course, we have the intermediate resistance identified by an overlap level and the extension at 137%. Now, in terms of support, we can see that the SPY ETF had broken above this swing high resistance at $575 on 12th of May. And when I stretch it all the way back, we can see that this is actually a pretty significant overlap level as well. $575 is a very significant overlap level that we can label as the first support. And we can see here a significant swing low being formed on 13th of Jan. See a bit of consolidation here, first week of March. Then we see resistance clearly being formed here at the end of March, creating a very significant overlap, which got taken out on 12th of May. Right now, on this uptrend, right, there's a couple of uptrends here. We can run Fibonacci retracement starting from this swing low on 7th of April, going up to the high of Monday, 19th of May. When we look at all the fibs, all right, on this uptrend, we can see none of the Fibonacci retracements sit close enough to the first support. That's fine. Let's try another retracement, this time beginning from this swing low on 21st of April, going up to Monday's high, which was yesterday. And we can see that the 23, in this instance, we can see the 23.6% retracement sit pretty close to, or aligns very well, I would say, with the first support at $575, which is an overlap level, right? So, and at the same time, I can probably even, I guess, spot a pretty decent ascending trend line, right? So we have a pretty decent ascending trend line where that has followed up with price here, right? So if this trend line gives way, perhaps that may be the first sign of telling us that, we could expect a slightly more deeper pullback, or maybe even a slightly more deeper correction. But for as long as this ascending trend line for the SPY continues to hold, right, we could see some consolidation, or and we could also see this ETF continue to grind higher. But if this ascending trend line fails to support prices, right, then we should be setting ourselves up for a much more deeper pullback, and maybe even a pretty strong correction, right? So these are the key levels for the SPY, which is the ETF that tracks the S&P 500 index. Now let's move on over to the triple Qs. And the triple Qs, this is the ETF that tracks the Nasdaq 100 index, and we can see, right, a very strong rally, very similar market structure to the S&P 500 as well. This ETF fell pretty deep into bear market territory as well, dropping as much as 26% on 7th of April, right, briefly entering deep into bear market territory before closing on the day, 7th of April, to close up slightly higher, but nevertheless, it did still close in bear market territory at losing almost 22%. However, since then, we can see a very strong rally materialized, right, and we have rebounded very strongly. Now, of course, in terms of resistance, first major resistance for the triple Q ETF sits at $539, right? This is a multi-swing high resistance, with the first swing high resistance taking place on 16th of December last year, and the second swing high resistance taking place on 19th of Feb. It's very clearly a very strong resistance barrier at $539.50. This is a multi-swing high, which we can label as the first resistance. Now, on this downtrend here, you can probably run a Fibonacci retracement as well from the intraday all-time high on 19th of Feb, going down to the swing low on 7th of April. Looking at all the fibs, And we can see, of course, similarly to the SPY ETF, the triple Qs have also climbed above all the retracement levels from 23.78.6%, signaling a very strong rebound, right? This is almost like the perfect V-shaped recovery for both of these ETFs. Now, I'm also going to try to run another Fibonacci retracement, this time from this swing high on 25th of March, going down to the swing low on the 7th of April. The purpose of this retracement is to look for key extension levels, which right sit at 137 and 161%. Right, we can already see the triple Qs have climbed above the extension at 127%, whilst we see the extension at 161% sit pretty far from the first resistance. So that's fine. We don't really need these extension levels either. Now, what about support? Let's try and identify where the major support levels sit. Right, I can spot a pretty strong overlap at around $501. Right, we can see that this was a very significant swing low that was formed on 13th of Jan. And we see some consolidation take place here on 20th of Feb, right? And as markets gapped higher on Monday, 12th of May, it dropped to bounce nicely off this level before, it dropped to touch this level here, to touch the overlap here, before rebounding very strongly. So you can see here quite clearly, this overlap level at 501 is very significant, and we can label it as the first support. Right. Now, on this uptrend, we can also try to run a couple of Fibonacci retracements. Let's start with the first one. Beginning from this swing low on 7th of April, going up to Monday's high, 19th of May. Looking at all the fibs, right, in this case here, we can see 33.6% sits pretty far from where the first support sits. That's fine. Let's try another retracement, this time beginning from this swing low here on 21st of April. In this instance, we can see that 33.6% aligning very well with the first support. So let's just keep 33.6% on the analysis here. Now, similarly to the SPY ETF, we can also spot a pretty significant ascending trend line. And once again, if this ascending trend line continues to hold, we can expect the triple Q ETF to consolidate and perhaps continue to grind higher. However, if this ascending trend line fails to hold prices of right, we can expect a much deeper pullback or even a much deeper correction. Right, so these are the key levels here for the triple Q ETF, which is the for the triple Qs, which is the ETF that tracks the S&P, oh sorry, not the S&P, but the Nasdaq 100 index. Right, now let's move on over to, all right, let's maybe touch on one of the currency pairs, right? Let's take a look at dollar yen, right? With demand for safe haven currencies such as yen and the Swiss franc surging, right? We can see that this currency pair, dollar yen, has been trending lower since mid-January, right? We can clearly see a series of lower highs and lower lows. And at the same time, this recent rally that took place in the first half of May, we can see it getting stalled pretty much within the red Ichimoku cloud as well, right? It was actually approaching what I see a pretty significant overlap level, right? When I look at 148.60, you can see that previously this level functioned as a very significant swing low back in the first week of December of last year. We see support being formed here as well at the end of Feb. Support once more in March, and we can see it stalling pretty much exactly at 148.63 on 12th of May. So very clearly, this is a very significant overlap that we can label, which we can label as the first support, the first resistance. Now, on this downtrend here, right, is on we can run a couple of Fibonacci retracements. Let's start with the first one from this swing high on 10th of Jan, going down to the swing low on 22nd of April. Let's take a look at all the fibs. Right, we can see here 50% sits somewhat close enough. So okay, let's see, let's keep it on for now. It's still not the best retracement, maybe. Okay, now let's try to run another Fibonacci retracement, this time starting from this swing high on 28th of March. Going down to the swing low on the 22nd of April, looking at all the fibs once more. On this downtrend, we can see the 78.6% retracement aligning very well with the first resistance. Right, so that's fine. We'll just keep 78.6% here, and we'll get rid of this 50% retracement from the first retracement, or the 50% level from the first retracement. Now, Just this week, we've also seen dollar yen break through what is, I would say, a pretty significant pullback support level, right? There's a pullback support level at 145.32. This level gave way, right? This level gave way at the beginning of this week. And we can continue to see dollar yen remaining under this level as well. So once a pullback support level gives way, such as this one here at 145.32, this level is likely to function as a little bit of resistance as well. But this is where we can identify a potential intermediate resistance barrier at 145.32. Now, in terms of the first major support for dollar yen sits at approximately 140.27. This is a very significant multi-swing low level where we have seen dollar yen reverse off very strongly on 16th of September last year, and then again as recently as 22nd of April as well. You can see here the market structure showing us a very significant multi-swing low level where dollar yen has bounced off a couple of times, right? So very significant support zone between 140.35 and about 139.70. Right along the way, there are several intermediate support levels as well. And we can see there's a nice uh, swing low taking place here as well. Pretty close to this swing low here that had taken place on 28th of April. So we have a nice intermediate support level as well at around 140 at around 141.96. Now on this uptrend, we can run a Fibonacci retracement beginning from this swing low on 22nd of April, going up to the swing high here on 12th of May. Looking at all the fibs, we can see that the 78.6% retracement sits pretty close to the intermediate support. So let's just keep that retracement level on. Right, so we can see here, right, demand for the yen remains strong, and we could see this currency pairs drift lower, dropping towards the intermediate support at 141.96, which is also accompanied by a Fibonacci retracement at 78.6%. Right, and just one more thing to take note of. Yes, probably this ascending trend line is pretty important as well. Right, there's a pretty decent ascending trend line on this uptrend that begins from 23rd of April. And if we see a clean break through this ascending trend line, right, that's definitely going to increase demand for the yen, and we can expect this currency pair to slide lower. All right, so that brings us to the end of today's webinar, right? Once again, thanks for tuning in to today's session on US tariffs, the evolution of US tariffs, and how it had impacted financial markets, right? Injecting increased volatility and market stress for all asset classes, ranging from equities, bonds, commodities, and currencies. All right, so do look out for all upcoming webinars brought to you by Vantage for the remainder of this week. And I look forward to catching all of you at the next session. All right, thanks everyone. Take care and have a great trading week.